Should you invest in real estate instead of the stock market? What are the benefits of real estate? Does it outweigh the stock market? And everything you need to think through when thinking about that decision. So as a reminder, I'm Ari Talblev, and I'm here to help you retire early. Now, in today's video, what we're going to work through is, does real estate make sense instead of the stock market? Should you own both, and to what extent? So I'm excited for today's video. I get this question often by clients and people who just want to know more about the subject. So we're going to go through an example to illustrate this, but very broadly speaking, just to give some guidance, if you had two investments, one that gave you a 10% rate of return and another one that gave you a 10% rate of return, which would you choose? Well, it might seem like a very, very stupid question, but it's not. Here's why. Because what you want to choose is the one that takes less of your time and less of your energy. If you had two investments with the same exact return, I personally would rather choose the 10% that doesn't make me do any work at all. So if we're going to choose this other one that does require more time and energy, I'm only going to select that one over this investment that takes no energy, no time, if there's higher return. And you might say, I want higher return. And if that's your goal, then awesome. It might make sense to invest that way. But here's an example to work through that in more detail. Personally, real estate can be amazing. There's depreciation benefits. You get to own real estate. You get to feel it and touch it. And it's really a tangible investment. And there's income from it. There's appreciation value. Real estate can be awesome. The stock market, I would say, equally awesome. It just depends on your goal. With the stock market, it's less of that direct ownership, less feel of that investment, but it's very real companies that you're invested in. And the beauty of it is you have to do no work at all. It's truly passive investing because you don't have to attend any meetings. You get to be a direct owner in the best companies in the world that are innovating, and that is so valuable. So let's work through an example to think whether real estate makes sense or the stock market based on what you're looking to accomplish. So in this example, I'm going to assume you have $100,000. Now, we're going to assume the stock market and real estate, they both get 8% from a rate of return, and we're going to assume that the stocks go from $100,000 to now $108,000. So that's what we're going to start with. Now, here's how most people would look at the math. And they would say, well, with real estate, Ari, if I put $100,000 on a $500,000 home, that's 20%. And that $500,000 turns into $540,000. Well, Ari, that $100,000 investment would turn to $140,000 if you were to sell it, which would be a 40% return. And so if you read that, you say, Ari, that same 8% is a whole lot more valuable in real estate than it would be in the stock market, which is true on the surface. But what they miss is, what is the cost of capital? What is the cost of maintaining the home? Property taxes, which on that home would be about $5,000 to $6,000. On a $400,000 mortgage, just assuming 30 years at 3.5%, that's $1,800 a month in mortgage, which is $21,600 a year. $13,800 of that is actually interest in the first year. So 64% of what you're actually paying is interest. Then there's maintenance costs, then there's closing costs, and the costs of selling the home. So in this example, the 6% closing cost of $32,400, that wipes out 81% of the gains caused in that first year of appreciation. So what I'm trying to convey is, when we're looking at real estate or the stock market, it's going to completely depend on that real estate property. I would never want to pick, personally, an investment that got 10% but took a ton of my time, when I could invest in the stock market and get 10% historically that takes none of my time, zero. And so to me, I'm only going to invest in real estate if I know I'm getting way, way, way in excess of that 10% return, because it's my time and energy. Now, I firmly believe your greatest investment over your lifetime is you. So my personal approach is, I don't own real estate, not because I think it's bad, but because I want to focus my time on my business, my clients, and what I think is most important to me, and let the stock market do what it's going to do by investing in a diverse portfolio that I don't have to think about in terms of attending meetings. Or, for example, in real estate, your roof might be leaking, a wash machine might break. Things are going to come up, and even if they don't come up, personally, it just takes my headspace. I don't want to think about it. Now, let's look at the opposite, meaning let's say that we do invest $100,000 and the market goes down by 20%. Well, you had $100,000 in the market and now you have $80,000. Well, in real estate, if you buy a $500,000 home and you get, call it that same $100,000 is what you put down, well, $500,000 now turns to $400,000. So $500,000, 20% of that, $100,000. Now we own a home that's worth $400,000, but we still have the mortgage of $400,000. So now when the market goes down, in the same way if the house went down in value by 20%, now one, you put $100,000 in, but that's essentially been washed away. You now have this mortgage of $400,000 and your home's worth $400,000. And so now, before going any further, this is why it's crucial to have liquidity with rental properties. So financial advisors will typically say, don't own real estate. Real estate people who are just selling, whether you're an agent or in the business, will say, don't invest in the stock market. To me, they are both wrong. It depends on your goals and really what you want to accomplish. If the goal is to create income and get as much return as possible, real estate might make sense, but it completely depends on that property, and you're going to want to run an analysis known as the cap rate, meaning after all of the taxes and expenses, what is the real return I can expect from that property? And then over here, say, what's the equivalent that I could get from investing in the market? Because personally, I would not want to see you get an 8% return with a ton of work when you could get a 10% return of no work at all. So here's what we want to look at. Here are the best considerations that I personally walk through with clients. Number one, what is the cash on cash return? If you have a $500 home that generates $25,000 a year, that would be a 5% return. Very simple. But let's look into account annual appreciation. And so if appreciation on a $500,000 home is 4%, which is the historical average, well, that's a good place to start. We've got a 5% return, and then a 5% is that cash on cash return, income, and then 4% is the actual appreciation. Well, that's great. Now let's look at leverage. Leverage is going to magnify the return, and leverage is going to magnify the losses. So it's both a very good thing and a bad thing, but that's something we want to be very aware of and intentional when we are deciding between real estate or the stock market. Now let's back out the cost of capital, the cost of borrowing money, and the cost of maintenance. Next, let's look at the tax benefits of depreciation and then compare that to the stock total return. So with stocks, it's very straightforward. We can just log in and see, okay, I made 8% this year, 9%, 10%, 11%. With real estate, it's not that straightforward. So that's one of the things we want to know is, for example, if you were getting a 5% cash on cash return and a 4% appreciation, that's what we're looking at on the surface. So on the surface, it looks like real estate would have a 9% rate of return in this example. And if the stock market had a 9% rate of return, that's equivalent. But now let's look at the next few factors. One, maintenance, closing costs, property taxes, all of that, we want to take that into consideration, and that's after the cash on cash return. That's after the real appreciation of the home. So in order to get that real apples to apples equivalent, that's the analysis we need to run, or else it's oranges and apples. The next few considerations is, how involved do you want to be? Do you want to be thinking about tenants? Do you want to manage a property manager? Because some people might say, hey, it's no work at all. And the reality is it certainly can be work. But you might say, I'm willing to do that work because I want real estate. Now, how much liquidity do you want? The great thing about the stock market is if something happens, you can pull your funds and have it in 3 days, 3 to 5 days, depending on the custodian exactly. But you can have that money, it's liquid, you can touch it, and it's growing for you. With real estate, if you put that money in, it's very illiquid. You can't just go and say, hey, I want to take $250,000 out of this home because now you have a bigger mortgage, you pay more in interest, and it can just complicate your situation. So to me, I often think that a liquid piece is a very big consideration. The next one is, what about the extra risk? You might say, hey, I really love real estate, and you end up carrying multiple mortgages. And that's where things start to spiral downwards, because you'll say, hey, I've got this business idea. Maybe I can use this home I have to help me facilitate that. And it could be wonderful. You could make millions of dollars, or it could make the situation a lot more difficult. The next thing is, do you want flexibility in your life? If you have 2 mortgages or more than that, you might not be able to scale back from your job as early as you might want to. It will pay off long term once the mortgage is paid off, but does it take longer to get through those hurdles? What is your desire for simplicity? Real estate doesn't solve this unless you have a property manager, but then you have to back that cost out of the total return. And then lastly, can real estate be a superior investment to stocks? The answer is yes, but it better be, because if you're investing in it and it takes a lot of your time and energy, well, then it's certainly really compensating you for that. Meaning you should get a premium for the work, effort, and risk involved. If not, don't do it. Once again, very simply, if you have two examples, one getting 10% rate of return, another with 10%, that's great, but make sure that that 10% that you're getting with real estate, you back out all of the costs involved, and if it's still 10%, and you could just get 10% in the market, well then I'd rather see you do the market. But if we run a retirement projection for you and see that in order to retire early, you need 18% or 25%, well then real estate might be great for that. And I'd say let's not do the stock market. I'm not married to anything. It's just what is best for you and your goals. That's it for today's video. What do you need to retire early? Check out more videos like this if that was helpful, and please share it with someone if you think they would take value from it. I'm Ari Taubli. Please like and subscribe, and I'll see you next time.